Happy New Year and welcome to Season 18 of ECCB Connects. Have you started making plans about how you'll improve your financial health and wellness in 2022 and beyond? We kick off this season by speaking with Assistant Professor at the Utah Valley University, Dr. Terrance Martin Jr., about how you can work on making 2022 a financially healthy and productive year. Stay connected. We'll share more with you after this short message.
The Eastern Caribbean Central Bank is rolling out Dcash, the next step in the evolution of the EC dollar. Use Dcash to send and receive money to and from friends and family. Make payments directly from your smart device. Make payments from wherever you are. Download the app from the Google Play or Apple Store and sign up, or visit dcashec.com for more information. The future of the EC dollar is digital. Let's make history together.
Dr. Martin, welcome to ECCB Connects.
Thank you for having me. It's a pleasure to participate in this series.
Great. And we want to say Happy New Year to you. It's the start of 2022, a year that people start off with big dreams, promises, hopes, and dreams.
I think the world is cautiously optimistic after the last couple of years that we've had. So Happy New Year to everybody. And season's greetings to all.
Yes, and as you said, we know we've been through a topsy-turvy last 2 years, to say the least, with everything that's happened with COVID and the economic and financial fallout as a result. And as you know, the new year is often a time when people reflect and think about how they are going to improve on what has gone in the past and be more successful and resilient in the future. So we have New Year's resolutions from, health and education and fitness happening. And in similar sense, we often think about how do we reset our finances to be more successful. There's a concept floating around about financial health. How can we be financially healthy in 2022? And from your perspective, talk to us about what is the definition when we speak about financial health? What are we talking about?
So financial health is almost like a subset of financial literacy, but in short, it's used to describe the way in which someone's managed their money affairs or their monetary affairs. And there's different dimensions, right? There are different areas. You could focus on the type of savings that you have, your approach to things like retirement, your approach to things like how you deal with credit. Are you going to pursue things like home ownership? What are your views on investing? So there are several dimensions of financial health. And, you could put them in several buckets, right? Money management, how you address borrowing, how you deal with investing, and then how you protect it all in terms of things like insurance and estate planning, things like that.
So having said that, what are some of the signs that we look for when we think about an individual who is financially fit and healthy? How would I checklist that I'm on the right track?
So in financial planning, there are certain heuristics that we tend to go by, right? If I was meeting with a client, or if I'm teaching a class and engaging students, I ask things like, do you have an emergency fund? Do you have access to a retirement plan? What percentage of your salary are your savings? Now, these are all relative, right? And these are specific to age. For example, if you're younger, you don't need to save as much. Let's say you're 25, you don't necessarily need to save as much as someone that's like 45, right? Because the younger you are, and if you, for example, you're investing, the power of compound interest could actually help you to save less in the long term. If you're a little bit older and you're a little starting out later in terms of things like retirement, then you may have to save more, right? So it's really dependent. It's not like a one cap fits all. That's the thing about anything that's personal finance related, is you have to really look at it from that person's perspective, that person's financial goals. Simple things like having an emergency fund, putting some money away in terms of savings, for those types of emergencies. And, starting investment, starting to think about the future and things like retirement. If you're lucky enough to work for an institution that has a retirement plan, you want to participate. So these are some broad checks. There's some ratios that we could use, which may or may not be applicable to the region because of, different tax structures and stuff like that.
Great. So you spoke about looking from an individual standpoint at what you have going on and then assessing, what it is that needs to be addressed. Let's take a specific case scenario. I'm in my 30s. I've been working for a number of years. I don't have any funds set aside. And particularly, I've been impacted income-wise because of COVID. So I'm coming from a less than optimal income earning situation, but I want to start getting financially healthy. Okay. What are some recommendations you would make to help an individual get on track?
We first need to know where that individual is, right? So things like drafting personal financial statements. There are tons of free templates online, looking at what's really your cash flow at the end of the month, at the end of the year, because we need to know where we're starting from, right? And then we also want to clue into the net worth, what's your wealth status? And if you're in your 30s, it's okay if you have a negative net worth. You have 30 plus years to counter that, right? So that means it's okay if you have more debt than you have assets, because in our 30s, according to something called the life cycle hypothesis, which basically means how can we be happy over our lifetime? It's okay as a younger individual, when just starting out in our 30s, that's when we're accumulating things like homes, businesses. So that's all right if your net worth is negative. So we want to start there, right? And after we see that, then we come up with some plans, a financial goal. We can't take you anywhere into the future without knowing exactly where you are or without having a plan. Because if what's the saying? If you don't have a plan, you plan to fail, right? So from there, we establish some financial goals. One, and you prioritize those goals, right? Okay, so if I'm looking at someone in their 30s, I'm engaging them, I'm asking them, what's most important to you? So let's take it, for example, emergency fund. After coming out of COVID, one of the biggest things I saw, even all over social media, is people not being able to afford necessities, right? And some people call it saving for a rainy day. All right, so what do we look at? We look at what's your monthly expenses, right? The fixed expenses versus variable expenses, discretionary versus non-discretionary. And we try to at least put in place 6 months of expenses in an account that we don't touch. Let's call that savings. So we start there. So we develop a plan to reach to that point, okay? Unfortunately, what COVID also brought with it was a lot of mortality issues. It showed the vulnerability in some cases of health and so on. So then maybe looking at insurance, life insurance. That would be in some cases a quick and cheap fix. I always say life insurance is how we could break the poverty cycle. Because, for example, in one policy, you could change generations behind you, right? So then some people might say, well, I don't need life insurance. I don't really have anything, blah, blah, blah. If you have kids, even if you have parents, if you have siblings, that's something that you could help, right? You could help in terms of paying off debt. And here's the thing, you could actually own life insurance on somebody else, right? So if you have an elder in your family, that's one ways in which you could
preparing for
exactly. It could be somewhat of financial arbitrage in that way. So I would start there. I would start by looking at their cash flows, looking at their net worth, developing financial goals around that they want to do. Because if they don't want to have these goals, it doesn't matter what you recommend, they won't do it. Build an emergency fund, start with insurance, even things like putting a will in place, especially if you have kids. These are things that largely the estate planning aspect could be a little costly, depending on the country that you're in, but these are things that we have to put in place to safeguard. And then from there, we could do anything else. If we have money left over, what we have a decision. Do we consume this? Do we pay down debt? Or do we save it? And I would like to echo here that paying off debt is a form of savings, because by paying off debt, you're actually saving that interest that would have accumulated over the life of the debt. So it's actually a form of saving. So if we wrap our mind around that, then we start to develop strategies. All right, let's get debt free. That's one way. Or let's start to invest, and the decision really comes down to what's the better return on my money. If I'm going to get 10% by investing, or I'm going to save 20% on debt. At the end of the day, paying off the debt will actually benefit you more in this case than investing.
It's interesting that you said that about debt, because another question that comes to mind thinking about financial health and wellness is saving versus paying debt. And we often hear that debate, well, if you had money, how would you, direct the funds? So it's really about examining the situation and seeing if I paid this debt off, I actually save money in the long run.
It really is. So I published a paper, I don't think it's out yet, but it was accepted this summer. And looking at credit status, the same question, right? There's some people that have the money in their savings account that could just pay off all the debt today, but they don't, right? So we call those solvent revolvers. Now you have some people that want to pay off the debt, but they can't. We call them insolvent revolvers. And we have people that just live debt free. Great for you, right? But for those two individuals who are solvent and insolvent, it's a real psychological decision. It really comes through. And it goes back to somebody's willingness to sustain financial risk. So if we really establish an emergency fund, for example, then the person with the solvent revolving mentality may be more likely to pay off that debt because they have a safety net in the emergency fund. All right. And then sometimes we look at, okay, with the insolvent individual, do they have the capacity? So what does that mean? If they don't have the capacity to pay it off, maybe then we start to look at things like debt consolidation, right? To make it easier for them, restructuring their debt position. So we have a decision. Once we know your cash flows, we have a decision, especially if it's a surplus, meaning you make more money than you spend. Do we consume it? Or do we save it? And then we need to start to look at saving, as I said, as paying debt versus investing. Now, traditional savings, what's that? Pay like 1% a year, if so much. I know in the US, it's like 0.1%. Now, if you compare that return that you're going to get for every $1,000, you're probably going to make $1 a year versus paying off $1,000 note with a 20% annual interest. That's saving $200, right? So it's really perspective. And yes, everybody is different, but that's where engaging, having the ability to talk to someone, figuring out their financial goals, short-term and long-term, will go a long way.
Now, Dr. Martin, we've been talking about COVID back and forth. And, the reality is persons have been negatively affected income-wise by COVID. So starting out 2022 on an optimistic note is difficult in itself. Mm-hmm. So what do you say? What advice in terms of getting financially healthy would you give to someone who is either unemployed or getting back on their feet, has debts to take care of? How does that person try to reposition themselves for a good reset?
You're absolutely right. COVID was terrible. A lot of people lost traditional income sources, labor income, but it also showed us the pathway to possibilities. And for the individuals, the resident citizens of the Eastern Caribbean, I strongly suggest that, one, we start to realize that the Eastern Caribbean is just a micro aspect of a global world in which we could participate in now, because we have technology. Here we are having an interview over Zoom, right? 10 years ago, this wasn't a possibility. Well, we had Skype or MSN, but it definitely wasn't like this. I've seen so many people on social media, for example, even influencers in the region who have monetized skills. All right, so you're employed in, say, for example, the tourism sector, and you're a bartender, right? And as a bartender and mixologist over the years, you've developed this craft where you understand flavors, you understand different types of alcohol, for example, and now your hotel is closed. What do? Well, write a book. That's a possibility, right? Write a book, make some videos, put them on YouTube, run some social media campaigns, get your friends and family to chime in. And to write an ebook now, an ebook is like 20 pages, all right? And you could have your special cocktails, you could get out there, you could build a separate brand. And then after that, you start to get some traction, people buy your book, then you could go into merchandising, for example, right? So all I'm saying is leverage your human capital. You have a specific skill set that others don't have, right? Leverage that human capital. Realize that I saw this because I saw a lot of people I know, acquaintances, friends, serve the market. I saw people getting into making hand sanitizers. I saw people getting into making masks, right? If you do have that skill, and if you don't have that skill, join with somebody that does, right? I think what COVID showed is the benefit of collaboration. If we could collaborate and work together and realize that no man truly is an island, I think, we could just be better off.
Dr. Martin, you've shared some very insightful, real information with us about how we can look at 2022 as a time to reset, get financially fit, not just for this year, but beyond. So thank you so much for sharing with us and speaking with us on ECCB Connects.
Thank you for having me.
And now for this week's financial tip.
In these challenging times, it is important now more than ever to set financial goals and use them as your motivation. You can have small or big goals, but remember to be realistic about them. In that way, you will be more likely to achieve them.
We've come to the end of this week's episode of ECCB Connects. Thanks for watching, and be sure to join us next week for another program when we share with you who we are, what we do, and how we serve you.